surface of how to think about entrepreneurship as a discipline
And
and rehosting business, rehosting accounting to entrepreneurship.
you're right, Mike.
Wrong conversation.
No, you're right. So, in fact, when I started these ideas in the beginning of the century, I went around to all the business schools saying, my version of that is, gee, guys, you have 100 years of building management stacks for execution, but there's no management stacks for innovation. And I remember at an unnamed university near Palo Alto with a serious business school professors literally patted me on the head and said, Steve, we consult for companies with 100,000 people. How hard can 5 kids in a garage be? And then I realized I was talking to people who back then didn't spend any time in startups. It just looked like, a small group of people where instead the methods, the goals, the culture, everything was completely different. So now 20 years later, we have our own management stack. We have our own tools. We understand they're different. And ironically, large companies and large government agencies are now trying to adopt the tools and techniques of that we've built, which is another story by itself.
But Steve, in recent times, I thought it'd be fun to talk about some new stuff, right? And we've had some recent conversations where you've talked about how the world's just kind of shifted underneath us, and if it's kind of like Ferris Bueller once said, the world moves pretty fast. If you don't look up, you might miss it. I think it would be cool if you shared some of your thoughts, because these have been some really fun conversations that we've had in recent times, and I think that not all of it's out there yet.
Well, I just think this notion of availability of capital is just kind of amazing. Mike and I remember when seriously a Series A was maybe $4 million, if that, and you got it from a very small group of people. It's hard to imagine. Not only there weren't any angels, there weren't any seed capitalists. There was just a very small group in either Silicon Valley, some around Route 128 in Boston, and if you were in life sciences, maybe San Diego, South San Francisco.
And Steve, what percentage of the company did you sell for that $4 to $5 million?
That was a 50% deal. And by the way, right? Not only was that a 50% deal, but it was taken for granted that the liquidity event would be an IPO, and to take a tech company public, you had to have like 4 or 5 profitable quarters. That assumes revenue, guys, with profits, and then guarantee your investment bank that you'll have another 4 profitable quarters after you're public, so the stock price didn't collapse. And then, of course, no investment bank was going to take the founder on a roadshow, for God's sake. That's when you hired a CEO who could wear a great suit and had a professional sounding voice and, looked like they came out of central casting, and they would go on the roadshow, and the founder was kind of like the crazy ant they hid in the corner. And by the way, it was an all-guy show. I mean, very few women, almost no people of color. That was the Valley, and till about the late '80s or even later. And just to think about where we are today is, a good number of startups raising SPACs or IPOs now have more R&D dollars than large corporations. The world's turned upside down. Large corporations are now stuck with albatrosses of brick and mortar stores or distribution channels that are not producing or ineffective compared to, would you rather own a movie theater or Netflix streaming service? I mean, pretty obvious. And the other thing is that, large corporations who built brands over a century now find startups building brands in less than a year. And, all that brand equity is gone. So startups now have immense advantages than when we were entrepreneurs. At best, you could hope to be an ankle biter. That is, at least get up to the ankles of some large company where maybe you could be a supplicant if they could be a customer if you were selling B2B, or get acquired if you couldn't go public. It's just hard to imagine how different this world is. We're now in charge, and we're now, meaning the entrepreneurs and the VCs. Very different world.
Hey, Steve. One. I've always really loved your history of Silicon Valley talk. It's like one of my favorite things that you do. And I'm just wondering, given that view that you have of Silicon Valley and the long history that stands, and the significant changes that both you just alluded to today, just from the market, but also with COVID and just kind of the spread of ideas and the spread of entrepreneurship to new corners. What do you think is the next stage for
Well, I think
Silicon Valley?
this is interesting, Anna. I think we were living through it before COVID, and this might have accelerated. And you guys are the experts, so let me bounce it off of you. What happened in the 20th century, it used to be entrepreneurs needed to be in entrepreneurial clusters. That is, a cluster was like Silicon Valley, where you not only had entrepreneurs, that is talent in a concentrated area, but more importantly, or equally importantly, you had risk capital in that area. And it was a geographic thing. I remember when VCs in Silicon Valley wouldn't cross over to the East Bay because it was too far. But in the last 20 years, entrepreneurs started appearing everywhere. AWS and other tools and the net, et cetera, allowed you to write code or even build hardware sitting anywhere in the world. But what we were still limited by is, well, you could probably raise a seed round in Dubrovnik. You're probably going to raise $100 million there. In fact, was probably a couple thousand miles away from a place where you could raise that amount of capital. In the last 5 years, I think that even changed. I think now that it's not necessary to be in a physical location, maybe for some firms or some types of entities, but it might just be happening. And with COVID, I think my hypothesis, Dan, it might have accelerated that the notion of having to be in physical proximity of your investors for even follow-on larger rounds may no longer be a requirement. And I want to throw that back to you guys. What do you think?
I'll take an initial stab at it. The way I've been thinking about it recently, this is going to sound a little arcane, but I call it the B2B metaverse. And it used to be that business was location bound and time bound, and people would say, "Hey, is anything going to ever equal Silicon Valley? Is it related to tech or entrepreneurship?" But now increasingly, we're seeing that people believe they should live in the cloud. So rather than engage in office culture, they're engaging in cloud culture. And cloud culture has two arbitrages. There's geography arbitrage, which means anybody who's good can be at your company. But then there's also talent arbitrage, right? And they're kind of related. So you can find talent anywhere in the world rather than just in your town. But you can also operate around the clock 24/7. And so that just flips the assumptions, just like lean startups not being execution oriented but discovery oriented, flip the paradigm for how you think about what's important. I think that cloud culture rewrites all the assumptions around what makes a productive team. And are the employees full-time employees? Is it a social contract, or is everybody who gets rewarded when they give the network what it wants? But it's more like a Hollywood movie production where people come together but aren't always together. It's not quite so tightly bound. And so I'm just fascinated by all the implications of the shift from office culture to cloud culture, both at the individual company level as well as just geographic hub level.
Mike, we just to riff on that for a second, we outsourced manufacturing at the turn of the century. Every company, hard to believe, that made hardware used to have a VP of manufacturing. Now, of course, most of them have a VP of supply chain, right? We shop the factories, we shop the employees, etc. If you think about it, we used to have a head of HR and facilities that now manage the physical places and physical org charts where people showed up. I think what you're describing is that there might be that same shift that went from, for better or worse, from manufacturing, that's another discussion, from manufacturing to supply chain, from physical employees to maybe even, contract employees or gig employees. Again, another discussion whether that's good or bad about the nature of organizations. Who were the guys who did Basecamp? They were the ones.
37 Signals. Yeah.
They were advocating this 10 years ago, right?
So one thing that I would point out there, though, is if you take that to the extreme, the interesting thing is that the United States doesn't actually have an advantage at that point. So
it is kind of interesting, isn't it?
It's the same way that disaggregated manufacturing then leads to you going global to China.
Right.
Like now, some guys who have a much lower cost basis creating code in, the Czech Republic will have a massive advantage over any developer who's living in the United States.
Well,
and so it begs a question.
Right, we've already gone there with cyber attacks, right? I mean, most of
100%.
Right, it's ransomware is probably the most profitable venture in the software business right now.
But I do think, Steve, that like the way I've been thinking about it at the limit, and by the way, I'm not trying to judge it good or bad. I'm just trying to make sense of it. Is like I think of like in the 1850s forward, we decided the most productive way to create stuff was mass production, mass distribution. Make a bunch of widgets, distribute them on trains, and eventually use the TV industrial complex to sell it to people.
Yep.
And now, and like late 50s, early 60s, we kind of reached peak centralization. But now my thought process has changed. Now I believe that the economy is being driven by mass computation, mass connectivity. And in an economy driven by mass computation, mass connectivity, the vertically integrated, tops-down, centralized company, I think, yields to a network of people that all have a comparative advantage wherever they are, regardless of what they do. And it's more like classic Adam Smith, Ricardo, invisible hand, comparative advantage kind of stuff. And it's, you get paid based on your comparative advantage and your ability to provide that comparative advantage to the network. And you can, you may not be a chief marketing officer of a company. You might be a C-lancer because you're really good at category design. And you do that for several companies at once or one after the other or things like that. So I think we're only beginning to see what some of the implications might be for good and bad.
So Mike, given your statement and given your audience, and now the rubber will meet the road if that changes the floodgate investment model, right? I mean, this is a great theory, and so it goes back down to, it's okay, are you going to invest in guys who are women who are no longer in innovation clusters? Are you going to invest in people randomly around the world?
Well, it's already happening, but we have to take it a step further. We have to ask, why are entrepreneurs going to want our money? Why are they going to care about us? You can ICO and you can SPAC and you can raise money on AngelList and all that stuff. And so it's, you can't be a VC who says, oh, hey, everybody else, look at how you're being disrupted and not look in the mirror, right? It's just like, so we're constantly kind of asking that question of, in a network-centric, software-defined world, how do you not just avoid irrelevance, but how do you become increasingly relevant?
Yep. And though I want to whip this all the way back to some of the beginning questions, if I can, guys, is that it still doesn't change, at least in my mind, some of the key individual characteristics of the founder, the innovator, and the founding team. I still found, some of the key characteristics that, for me, were 40 years old are still relevant in successful teams. So whether the founder is relentless and curious and agile and, all the tenacious and all those things, do they, one of the stories about me, which I kind of laughed until I realized it was true, where everybody else, thought you were supposed to wait in line, I thought you were supposed to be first. And that line's were for other people. And I don't mean that to be rude. I just mean that to be, that's what I kind of did as a founder. It is, at least back then, when capital was scarce and survival was a paycheck to paycheck was just, every day was a struggle. And we, most of the time, did that. And half the time we're creators and half the time we're liquidity events. So it's the same team.
So I'm wondering if we should invite some other folks up to ask some things, because I've got a ton of questions, but I'm afraid we're gonna monopolize the time with all of them. Sean, can you help us figure this out?
Absolutely. If you guys have questions, feel free to raise your hands and we can bring you up. In the meantime, I have one. It's for all of you here. We started the conversation talking about your class at Stanford, and then Mike started talking about sort of how business school emerged, and so we've also talked about how sort of the environment for starting companies has changed So what does the business school of the future look like that sort of takes into account how the world has changed around it, particularly as it relates to the future of entrepreneurship education?
Well, it depends who you ask. Remember, business schools are a business. If you're at Harvard, business school still rotates around case studies. If you're at Stanford, business school rotates around innovation and entrepreneurship without kind of dogma, or at least a lot less dogma. If you're somewhere else, it might, be around a technology area. I think we've run the MOOC experiments and discovered, that was great in theory, didn't work in practice. And to be honest, I'm not sure what's going to be physically different. The subjects might be different, but I still think the structure might be the same, unfortunately. But that's my 2 cents.
Hey, Mariana, welcome to the stage. You have a question for us?
Hi, Sean. Thank you so much for inviting me. Hi, Steve. Hi, Anne, Mike, Eric. It's so pleasure to be here. I have a quick question about the social media apps. There's such a strong growth in audio. Obviously, there are people who are trying to create kind of Canva, hybrid social platform for music creativity. What's your take on that?
Mike or Ann?
Ann, do you want to go first, or do you want me to go first?
Go.
All right, Mariana, I'm going to give it a try. It's interesting. My thinking on this on social has kind of evolved in recent times. I tend to believe that the tech industry moves in waves, and so you had the mainframe, and then the microprocessor, and then the internet, and in those waves, you usually have some dominant platform companies that ultimately become the profit takers, if you will, and then things shift. And so, for example, if you'd asked me in 1989, is it a good idea to start a company that builds a killer app for Windows? I would have said no. I would have said that war's been won. Microsoft's the platform winner. You ought to ask, what's the next thing and change the subject. So until recently, I thought that was kind of what was happening with social. I thought that Facebook and Twitter and companies like those had, for the most part, sucked all the oxygen out of the room, that they had all the distribution, and that, like Microsoft with Windows and Win32 APIs, I thought, it was pretty much over. But I've had to kind of think differently in recent times, because I think that the problem that a lot of the current social products have is they're dependent on advertising, which means they're dependent on monopolizing your attention. And when you're dependent on those two things, there are opportunities, I believe, for new businesses to emerge that don't monetize based 100% on your attention or how long your eyeballs are kind of in the platform. And so, Ann's made an investment recently, in a company, Pop Shop, that kind of combines social aspects along with commerce. And here we are on Clubhouse, right, which wasn't even a company a year ago. And so I guess I'm now believing that social almost always makes any given category product better, and that social is now, to me, like what the graphical user interface was in the mid 80s. It's just going to be intrinsic to a lot more products than we realize. So now I'm kind of more open to the idea that there could be a lot of new, interesting social plays. I don't know if that really gets to your question directly, but that's kind of how I'm thinking about it right now.
Thank you, Mike. It's just there is so many discussions about content creators on this app, Clubhouse. Should the content creators or the people who own data actually, should they be compensated for it? How about the sharing economy? So I'm also curious to learn what's your opinion on that.
Yeah, I think it's interesting because Twitter just made this announcement around super followers, where the creators will be able to, with following, can actually monetize that. I think actually that is the direction of the future. If you have an influencer within your platform, if your influencer doesn't monetize within the platform, they're going to go elsewhere to monetize, and that's a problem for that platform. I also think that monetization is the key to unlock how do you actually monetize the network outside of advertising. So I think like we're going to start to see some really interesting innovation over the next, even couple of years. We're already seeing it now. I think the second point I would just say is just like quickly, the impact of COVID is significant in terms of what we've seen for consumers. And like I talk about this with our team, I call it the future of joy. Like, what is the future of joy? Where will people find connection, love, things that bring you happiness? And I think there's huge categories that will be created in the future because everyone has changed their behavior.
Yeah, just the one last thing to add to this. There's kind of this narrative that goes around that talks about robots are going to eat the jobs and software is going to eat the jobs and tech is going to eat the jobs. But I'm seeing the opposite. I'm seeing software eating the need for people to need to join companies. And so software puts an Iron Man suit on individuals. And individuals used to need the infrastructure of a company to do marketing and sales and to generate demand and get distribution. And these platforms just keep getting better and better, which unshackles there's maybe 10 million gig workers, but there could be 50 to 100 million solopreneurs just in the U.S. And so I think that is a really interesting trend that's quite compelling. But 100% agree with Ann. There's the platform that you offer them to monetize their talent, their creations, has to create an economic trade-off that's worth them staying.
Thank you, Ann and Mike.
Thanks for the question, Mariana. We've got another question from Maddie, who's one of our portfolio founders, actually. Maddie, you want to ask your question?
Hey guys, yeah, I'll make this quick because I've got some background noise behind me. But my question is about the future of work here and whether or not you think that remote companies will be here to stay, all remote. Will we be on Zoom for the next 30 years? And then if so, like what are we going to lose there? And what ideas do you have and what things do you think will pop up? It kind of ties into the idea of how will we define joy. And then there's a slightly other question